All right, welcome back to episode 13 of the More Doors podcast. Today we have some special guests on, Shamir and Chris from the Patel Law Group. So we're going to break down some of the state of the market, everything that's going on with that. You're going to want to tune into this one. We're going to get started right now. All right, welcome back to the More Doors podcast. This is episode 13. So I'm going to always tell you, go back and listen to the last one. So episode 12, we had Kaylee on with the she is the apartment queen.
Very good episode.
I mean, really, really good.
Yes.
Love that one. So today I'm excited to bring you, we're excited to bring you, not I. This is not all about me. No I in team. We're excited to bring you Chris and Shamir from the Patel Law Group. And today's show is sponsored by Deep Blue Capital. Just go to deepbluere.com. Look, if you're wanting to grow your money, your wealth, have some tax write-offs, shelter it, maybe hide it.
Maybe hide it from someone.
Maybe launder it.
No, we have the attorneys
That
on the
wasn't
phone.
true.
Come on.
That's why we have them here. Just go sign up for our newsletter over at deepbluere.com. And just tell them the guys from the More Door podcast sent you. They'll know what to do. So deepbluere.com. So, hey, guys.
What's up, buddy?
What's going on?
I feel like I haven't seen you in 12 hours.
Yes. Yeah. I feel like this is full-time podcasting now. This is what the radio people feel like.
We're playing catch up.
Yeah, we're playing catch up.
We're playing catch up.
Yeah.
We're back to our regularly scheduled programming next week.
Yes, we will.
Well, I mean, they won't even know. Because
Well, sort of, because we'll be gone. We probably
Yeah.
need to do another show right after this to get
Probably.
ahead,
Yeah.
because we're
Yeah.
going to miss next week.
Yeah.
Yeah.
I mean, either that or we can just do it from the beach.
Are you
That'd be
going to
cool.
Miami?
We're going to Montauk.
Hamptons, baby.
Ooh.
I know.
Up northeast.
Bougie.
Old people
It's gonna be
money.
cold there,
Or
though.
old money.
That's okay.
No, it's going to be in the 70s.
For that area, that's cold.
Is it cold?
I don't know.
Oh, for that area, for Texans, it's cold. For that area, that's definitely beach weather.
You had to jump me yesterday when we left because the sheer
We don't talk about that.
heat killed my battery.
Yeah.
So I'm fine with the weather being a little
Yeah.
cooler.
Yeah.
Like,
I think I would have taken that invite.
we don't usually invite Nick to stuff because he's like a perpetual no guy.
No, you know what? I like the invite. I love the invite, but I just will always 99.9% of the time will say no. I just love the
You
invite.
just love
Oh,
being invited.
okay.
All right,
Good
we'll
to know.
remember That.
Yeah.
Yeah.
Just
Don't send him a bottle of Jim Beam for his birthday.
No Jim Beam.
And just make sure you send the invite.
Exactly.
Okay.
All right.
Expect a no, but it's nice to send.
All right. Yes. And if you send me a bottle of Jim Beam, I will always
You're
say
cut
no,
off.
and
You're
I
cut
will
off.
call you out for that.
Yeah, exactly.
From here on out, I'll never let that die. So let's bring on our guests, Shamir and Chris from the Patel Law Group. They sent over their bios, but we're going to let them introduce themselves because it's really long. That's what attorneys do. They make it long and complicated, and
Cover all the loose ends.
Yeah, that's why we pay them the big bucks.
Yeah. But I mean, these guys are actually also pretty cool.
Oh,
They have-
super
they-
cool.
Yeah, they have a lot of good stuff about themselves and their company.
Yes.
So
yeah, there's an
that's
eye.
why their
There's
bios
an
are
eye
long.
in their team.
Yes.
Yeah, 100%. So Chris and Shamir, welcome.
What's going on, guys?
Hey guys, appreciate you guys having us on.
Absolutely.
We did not endorse the money laundry, the money laundry comment before.
Yes.
Yeah, they're going to put that on record.
How did that make its way into the conversation in the first 90 seconds? These guys are probably scratching their head like, is it too late to bail?
Yeah,
No,
exactly.
this is why we have the attorneys on. So, Shamir, why don't you kick this off? Tell us about the Patel Law Group. Tell us about yourself, and then we'll go over to Chris.
Yeah, definitely. So my name is Shamir Soni. I'm managing partner at Patel Law Group. I run the real estate practice here at the law firm. 90% of our deals, or my deals, are multifamily transactions. We have been particularly active in the last 3-4 years. 2021, probably did 200 plus deals, over $1 billion. Same thing with 2022. 200 plus deals, $1.4 billion. 2023, not so much.
That's why you guys have. That's why you have time to talk to us.
Yeah.
Exactly. 2023, we got more spare time. We're gonna do more podcasts. We also, because we own the law firm, we also owned until recently an office of Fidelity National Title, where we would close multifamily and generally real estate transactions, both commercial and residential. And that gave us a really deep insight into the title side of real estate as well, which I think that is often overlooked. And the problem solving kind of complexities in large commercial transactions. So that's the side I run. Chris is my partner at the firm, or one of my partners at the firm, and he runs the securities and fundraising side, and he can talk a little bit more about himself. We actually rescued him from California, so he's one of the many saved folks that have moved from California to Texas, and we're so excited to have him on our team.
Absolutely. Yeah, let's bring Chris in on this.
Yeah, just don't hold that against me. I did move here from California 2 years ago. Loving it here. Very smart move. But I've been practicing law about over 20 years in Southern California, corporate and securities attorney, and sometimes I would be a professor, but I'll try not to do that today to bore anyone, put you to sleep, but for UC Irvine's School of Law. I also was an entrepreneur and CFO of a publicly traded company, help people raise capital, and that's primarily what I do here at the firm. Real estate syndicators or create investment funds for them to raise capital for their deals anywhere in the U.S. And last year alone, we helped people raise about $450 million in securities offerings. So we're pretty active in the market. We're based in DFW, but we handle clients all over the U.S. And so we're just very happy to be on here with you guys.
Fantastic.
$450 million. Million.
Said it
That's
like it was
almost
nothing.
Almost half a billion. I feel like we should almost give like the Austin Powers thing. Or Dr. Evil.
I love it. Well, so let's just dive straight into it. You know, we talked a little bit before the show just about kind of some of the talking points that you guys wanted to touch on and things like that. You know, obviously, you know, Shamir, you just made a comment earlier around the kind of the difference between 21, 22, and now 23. On the side that you guys are specialists in, what are the massive differences that you're seeing in the market right now? That's, you know, nobody gets tired of talking about that because the market is ever evolving. What are the things that you're seeing right now that are so much, you know, more drastically different than the last few years, and where are things trending right now on your guys' end?
Yeah, absolutely. And I think that's kind of a topic that's ever evolving. So, you know, the last kind of 12 to 18 months, interest rates are kind of wreaking havoc with what's happening on the multifamily side. I tell our clients, you know, multifamily is almost a form of financial engineering. So the inbound capital and the outbound and the return are a function of one another. So, you know, thinking about it that way, you know, as rates have skyrocketed and moved so quickly, it's affected our ability. We'd go into contract at X, and by the time we get to closing, you know, interest rates have already popped another 50 basis points, 70 basis points, whatever it is. So, and that just, you know, causes problems all over. What we've seen in the short run, so let's take the last 30, 60 days, is some stability there. So we're seeing kind of cap rates stabilize a little bit, and folks are able to actually get deals done in a manner that's somewhat, you know, predictable. And so that's been really helpful, and we're starting to see an uptick even in our office on PSAs, you know, transaction volume, transaction closure, all of those various elements that are important to getting deals done.
Sure.
The other big shift we've seen over the last, I would call it 6 to 12 months, is a shift in the composition of who the buyers are. So on the sell side, we have our kind of our standard clients, which are the folks we've represented for the last 3, 4, 5 years. They're, you know, syndicators out of syndication groups. They're Texas-based families. They're folks that have held property for, you know, many, many years, or have rotated through via 1031 or whatever it is, a portfolio of multifamily or real estate assets. What we're seeing more recently is the reemergence of buyers out of California and New York who weren't as active over the last couple of years prior.
Sure.
Because they're starting to see value in Texas, and they're starting to see degradation in value in California and New York, where they've had outbound population migration, you know, issues with legislative, you know, things going on in California and craziness. So a lot of that capital is moving here and starting to set a floor on pricing and expectations as deals move forward. So that's been kind of one of the big big observations for us is once you hit this kind of floor, there's somebody from California or from New York to step in and pick up the asset at that value.
Now, do you think? Sorry to jump in there, Shamir. Do you think that's because those types of investors from afar are either A, more insulated about the North Texas market and perhaps not as stuck in it, so they can see the forest through the trees, or do they perhaps have different return expectations because of the performance of assets in their area?
Yeah, I think it's both. I think when you're coming from, take California for example, right? When you're coming from a market where your rent increases are capped because of legislative, initiatives, where your ability to evict a tenant is limited by legislative initiatives, where your ability to develop new property is limited by zoning issues. At some point you're just like, this is not worth it anymore, and you're not, sure, 6%, CD is good, but they want to put that money to use and continue to drive value. And I think for them, moving to Texas multifamily presents them the opportunity to generate a return over a longer investment horizon that exceeds what they would get in a risk-free security right now. So that's the other thing. I think that when you look at some of our Texas clients, they were either syndicators or they're using outside capital, which means that their return profile, the time for which they want to hold capital, is shorter. The folks that are coming from out of state have a longer investment horizon, and so given that longer investment horizon, the prospects in Texas or North Texas are stronger than where they're located in their home markets.
Yeah, I've seen that, and just in the assets that I've been liquidating, is the family offices from California have been coming out. They're looking at Arizona and Texas, and Shamir, you're 100% correct. Is their hold period is longer, right? So you've echoed that, and I think you've hit the nail on the head that the opportunity, if you're holding right now, the opportunity is you can still sell it at a pretty decent return if you've held it a while.
Gotcha.
Yeah, I mean, I think people, obviously we often compare to the tax-free return rate. You've got to add in kind of the tax benefits of multi, right, from a depreciation perspective, and also when you're looking at it as a family office, they're as much in wealth preservation and conservation mode as they are in wealth growth mode. Right. So they're not only looking to generate outrageous IRR, they're also looking at what is my downside risk and how careful am I with respect to that downside risk. So they're much more, their analysis is much more around risk-adjusted return versus pure IRR targets.
So are you seeing them gravitate, you're talking family offices, are they gravitating more towards certain asset classes like Class A and things like that, obviously, because they're not looking for potential, massive value add upside?
100%. So I think what we've seen is 60s and 70s assets are still struggling, right? So, even in our conversations with brokers, the kind of time on market for a 60s or 70s asset is significantly longer than 80s forward. And the problem is, I think the pricing delta between an 80s asset and a 70s asset or a 60s asset still hasn't absorbed that risk, like the boiler chiller risk, the cast iron plumbing risk, the stab log panel risk. Like, I don't think that delta has absorbed, has really factored into pricing yet. So right. I think you're still going to see some further, dips in pricing on the 60s and 70s side. I think 80s is somewhat stabilized now.
Yeah, and I think that's just, for actionable stuff, if you're an operator or an investor looking to get into deals, like what you just said, Shamir, is such a actionable item in the sense that the difference between an 85 vintage and a 65 vintage, it just feels like the difference between 40 years and 60 years, but it's a totally different animal. The technological development in building, in that 20-year span, it's a completely different asset. The risk profile is night and day.
Yeah, 100%. And I think the challenge that kind of some of our clients have had is, if you're going to take that 60s risk, you got to be compensated for that. Mm-hmm. And I think that the market still hasn't truly compensated those buyers for that risk yet, because the sellers that bought into those 60s assets, 2 years ago, they weren't adequately compensated for the risk, right? So those sellers are now not wanting to compensate the subsequent buyer for the risk. So the pricing still hasn't come into alignment there. like it has on like an 80s deal. That's much more feasible.
I agree.
Good
Don't
stuff.
buy other people's mistakes.
Yes.
Yeah, I mean, I think that I think I always joke, like, we had guys over the last few years that would be like, "Oh man, I've made so much money in real estate." I'm like, "Yeah, what's your point?" you know.
So is everyone else.
I look forward to those guys, 12, 24, 36 months from now, where I'm like, "All right, what did you sell over the last year, and how'd you do there?"
Yeah.
It's if you sold stuff a year ago, a year and a half ago, 2 years ago, and bought it 4 years ago, I mean, sure, like cap rate compression was great.
Yeah.
But what now? The rubber hits the road, and you're gonna have to execute on a business plan. Let's see what you can get done.
Yeah. Shamir, one of the things that we've been trying to spend some time weeding through is the true motivation for some of these assets that are on sale today, right? And, on some of these broker-led transactions, we hear probably most commonly that they've quote-unquote executed their business plan in 2 years and they want to exit. 2, they are going to recap their capital and go roll it into something bigger or in a different market. But we have this theory, and we've been talking a lot about this, that there's a lot of deals that are on life support because of floating interest rates or bridge loans that can't be refinanced and all that sort of stuff. Based on your conversations on the sell side, what's really going on out there on people that are looking to exit assets?
Yeah. It's kind of a weird situation, right, where nobody really wants to tell you the truth.
But they tell you the truth.
Generally, like, I think that assets acquired in 2022 on any form of variable debt are in pain. Assets acquired in 2021, less so. But our clients, the guys who I think are like really in trouble and I think are really struggling right now, are the guys who really bought within the last like 12 to 18 months and were like, "Oh shit, okay, like I got to pick up an asset before the market tumbles."
Right.
And now they're kind of like, "Crap, we shouldn't have bought that. We should have just waited." And I think that kind of layers into what I think Chris was going to talk a little bit about with respect to capital calls and how we're managing kind of the need for it, or our clients are managing the need for additional capital on deals that they've acquired within the last 12 to 18 months and kind of what to do there. Like, how do you communicate with investors? How do you communicate with your lenders? What's the optimal structure to bring in that additional cash to extend your rate cap, to give you a little bit more runway on reno, to give you a little bit more runway if you haven't hit those occupancy goals that you wanted to hit when you were putting together your business plan.
And I would love Chris to jump in on what that looks like, because we're seeing this kind of all over. Shamir, you just said something again that I think just echoed for the last few years, right? Like, I've got to pick up an asset before the market tumbles, which is if that's not the most groupthink thing I've ever heard in my life. It's like
there's a lot of FOMO, right? It's a lot of like FOMO investing.
Yeah.
And I think you saw a little bit of that on the LP side as well, where people were like, okay, last year we had depreciation's going to go down. The accelerated depreciation was going to change. So let's get dollars in before accelerated depreciation rules change.
Yeah.
The bridge debt's going to go away. Let's get a deal done before bridge debt's going to go away.
Yeah.
Some of those things that where the market, like bridge debt going away was probably a good idea when it did.
Yeah.
Otherwise, there'd be a lot of really, there'd be a lot of shops in bad shape. I mean, I know of at least one debt shop that's underwater on like every one of its deals in a particular market.
Sure.
And they're publicly traded, right? So it's like, oh shit, okay, well, how do you kind of relay that to your investors other than just hold to maturity?
Whoops.
Yeah.
Sorry.
Yeah.
Well,
any
sort of
maturity.
Yeah. I mean, any sort of specialized financing to get a non-specialized deal done is always going to be there's going to be a end of the music, and in 2018, going back, how many deals were done in 2018 on any sort of variable debt that wasn't some sort of very unique deal with a unique business plan? Was it many?
Yeah. I mean, that's the thing, right? Is like there were a lot of deals done speculating on historical rent growth, like that the rent growth patterns pre 2021 would continue into through 2026 when you're done. And in all reality, that was kind of a bad idea, or it was a bad assumption.
Yes.
And that's fundamentally what is now leading to this trouble, right? So like we have this confluence of like property taxes, insurance cost, and now this stagnation in rent growth, and all those three elements are kind of creating this storm of like, okay, shit, now what do we do now? And that's fundamentally what's driving kind of where people are like, oh, look, like multi is in this really weird shape. What's happening? It's really those three elements of like interest rates, insurance cost, property taxes, and then rent growth, rent growth stagnation.
Is there possibly and you guys represent sellers, so maybe this is like a blink twice if the answer is yes type thing, right? Is there a fourth? And my thesis there, and this is where we talk about potential capital calls and things like that. I believe that rate cap escrow premium increases are a massive fourth variable that is driving more people to sell and use that, we've executed our business plan kind of excuse, because in order to keep their business plan alive, the price of that has increased 25 times in the last 2 years.
No doubt. And I think that's absolutely a valid element. Generally, most of our clients bought either 2 or 3 year caps.
Yeah. And
so if you did a deal in 21, your cap expires in either late 23 or 24. Mm-hmm. If you bought a deal in 22, your cap expires in 24 or 25, right? When you talk to clients, honestly or dishonestly, they're going to tell you we have enough cash in the bank to get us through our first cap extension, because they've been holding off on renovation. So what they're saying is like, look, like rent increases are slowing down, right? So this money we had set aside for capex to renovate units, we're now going to shift towards. We're not going to use it for capex to renovate those units because those renovated units are not getting our underwritten rent bump. So let's take that bucket of money and move it towards purchasing an extension to our rate cap.
Right.
Now that's kind of like shuffling deck chairs a little bit.
Yeah.
But that's part of the conversation our folks are having with their lenders. And look, lenders are trying to find a way not to just take a bunch of stuff and put it on their balance sheet.
Yeah, they don't want a bunch of stuff back.
No, they don't. I mean, they've got investors, they've got ratings, they've got all kinds of things they've got to worry about. Taking back a bunch of deals is not a good idea.
Right.
That's not the play for them. So, they are being somewhat reasonable. They're allowing forbearance. They're allowing our folks to say, let's extend, let's do a few things to keep things moving along. And so that is out there. The other part of it's also like, with the way the Fed is kind of headed, everybody's playing a little bit of chicken there, in terms of when the Fed indicates that it's going to start cutting or potentially start cutting. And the idea is like at the first rate cut, rate cap prices are going to collapse, right?
Right.
Because rate cap prices are a function of the forward interest rates.
Right.
So as soon as the Fed indicates, hey, look, we're about to start cutting, like those cap prices that were based on a forward curve that looked like that are now going to be based on a forward curve that goes down, right. And therefore those prices are going to collapse. So there's some kind of speculatory nature to this in terms of what's going to happen with forward interest rates.
This is a fun little Mexican standoff we got going here.
Yes. It is. No, 100%, man. I mean, it's a little bit of a game of chicken, and it's a game of chicken with a lot of money on the line.
Yeah. Whew. So we got to get Chris involved.
Yeah.
I'm just sitting here thinking, Chris has the patience of a saint. Chris,
it's always the Shamir show, anyway. So
now, so I have a question, but I'll save it for the end about how the two of you kind of work together, right? Because we've done 4 deals with Patel Law Group, right? 4 out of my last 5 deals have been with PLG, and I mean, I think you guys are great, but I think what you guys do is a little different than some of the other well-known companies out there from a syndication perspective. So let's come back to that. But Chris, tell us a little bit about what you're seeing in this market on the security side, please.
So yeah, I mean, it's you've got a lot of people, existing clients who are, like Shamir said, they're really facing some cash flow issues, and they're coming to us saying, hey, how do we do a capital call? Can we go out and raise more capital? How does it work? And essentially, yes, there's a legal component to it, but a lot of times I end up advising them more on investor relations, on how do you message this to your existing LPs, or potentially go out to new LPs to bring capital in, because the LPs who are in your deal, they don't want to throw good money after bad. They're getting hit up maybe on other deals for capital calls. They're wondering where to put their capital. So it's really more about messaging to your investors. And so we're seeing a lot of that. A lot of clients, especially with the more recent deals within the last year or two, like maybe 18 months, that are facing those cash flow issues where they're having to go either do capital calls or even do a new offering. And some of them are looking at potentially debt offerings. And we're seeing a huge change in what investors are looking for, obviously based on the market. We're seeing preferred returns. Everyone wants a preferred return. It was 6% before. Now it's 8, 9, 10, 12, 15, 16% preferred returns that people are expecting. It just keeps going up and up and up. So you have to factor some of those costs in, and the cost of capital is challenging these days.
Sure.
Yeah.
And obviously, I mean, you would always advise, if you can, to go, do a new offering than do a capital call, just from an investor relations standpoint, I would imagine.
Why?
Like the good money after bad money thing that we were talking, the idea of going back to people that you advertised a projected return for, and now the deal is sideways, and having to go back to that same investor group, I think is probably a little bit more difficult. But that's I think that's more of a personal opinion.
Maybe. I mean, let me ask Chris on this. If you go to a new offering versus capital call, it's still on a capital call for those that let's say they don't have the money, and someone else makes up the difference. They're just getting diluted equity, correct?
Yeah, I mean, they're going to get diluted whether you do a new offering or a capital call if everyone doesn't put their money in. So they're facing kind of the same thing. And some of what you're saying, it's about messaging. Like, what did you tell your LPs? Here's our business plan. And then you're going to come back to them, especially on the newer deals where you're coming back 6 months, 12 months later saying, hey, you know what, we didn't really plan for this. And, we need a lot more money, especially when it's not just a couple $100,000. It's, hey, we need $10 million more.
Wow.
And when it comes to messaging to your investors, you also have to think about, usually the way we structure it and most syndications are structured, there's an ability to do a capital call. It's usually optional, not mandatory. So you can go to your existing LPs and do a capital call, see who puts money in. But if you want to do a new offering, a lot of times those are not structured into a deal. And so like whether it's an LP agreement or your operating agreement, PPM, you may have to go get potentially consent of your existing LPs to amend your operating agreement. So they're going to find out anyways at some point that you're raising capital. So in some ways, if you're going to do a new offering, you should offer it to your existing LPs first.
Correct.
To give them a first right.
Yeah, that makes sense.
And as long as it's messaged properly.
Yeah, in my opinion, like, again, it's the in anything, it's the risk of investing.
Oh, sure.
Right. So look, I mean, it's like Shamir said, all these people bragging how they made money over the last 3 to 4 years. Honestly, I'd love to do some case studies on anybody that lost money during that time, just to see what happened.
Yeah.
If you're one of those people, come on the podcast. We'll do the blurry thing over the face and disguise your voice.
Do the witness protection voice.
Yeah, because that is something that as syndicators and raising capital, it's like it's like in that Disney show Bruno. You don't talk about Bruno. Yeah. Like you don't talk about capital calls.
Yeah.
And it's almost like that hitting that nuke button. And in my opinion, it's like we're all investors, right? And there's times that we've invested in things that have not gone well, and so it's something that should be talked about and discussed, even when you're raising money and saying, look, you understand. You're signing that in the PPM anyway. You understand that this could go belly up. You understand the worst case scenario is we lose all our money. But if things don't go according to, if they don't work out in the business plan, or something, God forbid, happens when COVID hit, and Brian and I are in a deal right now that looked like a sweetheart deal, and they paused distributions. There was, when rates skyrocketed, we were afraid that the rate cap company was going to be insolvent, and now we're facing the same thing that I think Shamir had mentioned, is like, we may be playing chicken a little bit.
Yeah.
And
well, we just got hit by a hurricane, so good times.
$9.3 billion.
It went upwards.
It went upwards?
Yeah, we're southern of that.
Okay.
We're west of it too.
Yeah. Well, we are, yes. But
Okay.
where that asset is, it's south of where that hurricane hit.
Okay.
But,
Okay.
property insurance will skyrocket.
So, Chris, we've talked a lot. So we've had Brian from Terrydale Capital on the show, right? We've talked to Kaylee. We've talked to a bunch of other investors about kind of where things are at and how we got here. But the deals that you're seeing where the GPs either need to make a capital call or a secondary offering, like where did they fall down, or where did they leave too many aggressive assumptions in their underwriting when they first bought the asset?
It's kind of all over. I can't point to necessarily one thing. And a lot of times what I see when people come in and they're like, okay, I've got this great new deal. And I try to go over, okay, we're structuring this, their operating agreement, the PPM, like, let's talk about the different issues in creating that document, because you can't always necessarily go back and change things very easily. Sometimes you need consent. It just depends. And so a lot of times when you talk about, hey, okay, how do you want to handle additional capital calls? Oh, we'll never need that. Well, let's be realistic. So I think the problem that I've seen is people are not realistic, or they haven't really done enough due diligence on the financial side and their projections to do a worst case, best case scenario. They just assume, everything's going to go amazing according to plan. Everything's been great for years. So we don't have to worry about capital calls. We'll never need that. We'll never need to do additional offering. Now clients within the last few months are saying, hey, on this new offering you're doing, let's make sure we have some options in there and talk about how we're going to be able to handle that. Because like you guys talked about, everybody was trying to get into it. I took my daughter to get a haircut. This was a couple months ago, and she heard what I did, and she's like, hey, I want to be a syndicator too. And, I heard there's so much money in it. And I'm like, do you have any experience? Do you just think you just walk in and it's like an ATM machine? So being more realistic and actually doing financial due diligence with your projections.
Yeah. And we've talked about that too, is like this, there were so many aggressive assumptions out there with, rent growth going through the roof for a long time and cap rates compressing. You really didn't need to be great in order to make great money for yourself, for your investors. And that's just changed. And one of the things we've been kicking around between the three of us is there's a lot of deals out there that aren't performing well, right? And we're hearing more and more about them as the days go by. But I think because of that, people are standing on the sidelines and waiting for a change, right? I'm going to wait till the market turns. I'm going to wait for this. Bottom line is this is all math, right? And I think both you and Shamir have said, kind of the modeling and best worst case scenarios. You got to know your data. You've got to underwrite it. You've got to shoot at it. You've got to really create very tepid inspection assumptions. When you're underwriting a deal, what I've started to do is actually, what happens if I have zero rent growth in year one and year two, right? Can we stay cash flow positive? Can we deliver on our preferred returns? Do we have enough padding? Are we raising enough capital? So for taxes and insurance, are we, we've adjusted insurance growth to either 10 or 15% growth a year for our 5-year hold underwriting. Yeah. People look at us like, you're crazy. No, we're not. I just got a 20% renewal on a deal like 3 weeks ago, right? Yeah. And like there's some of these signs are so glaringly obvious that it'd be a shame to miss them and put your LP capital in the line of fire. Yeah, I think the other thing too is there's a lot of people out there, right? So people that we raise money from are either sophisticated or accredited, right? And some people are shocked about a capital call or a secondary offering. How many of those people ever bought a stock on margin that went down and they got a margin call?
Right.
Right? I mean, not everything goes up. And like when you get a margin call, you can make a decision whether you're going to meet the margin call or sell out of your position, right? Because you end up owing somebody money.
Right.
Right? And the intent is never there, but it's also like you can't have an assumption that everything's going to go up. Right? At some point or another, the law of averages kicks in, and you need to make sure that you have a diversified portfolio with good performing and moderate risk assets that are going to sustain.
Sure, I think that, and maybe Chris with doing the communication side of things, that's kind of on the operators of the syndicators, right? In terms of how they do the presentation, because I've seen it where they just they're navigating the landmines out there that they kind of know, but they're only talking about so much of the positive. There's no way this can fail. We've done our due diligence on this, and this. We've thought of every angle, and it's only going to look good, and it's only going to be better for you.
Right.
And we're going to hit all of our returns because we're going to execute our business plan. And it's never talked about what happens if we don't.
Right.
And in my opinion, look, I'm the skeptic, right? We've talked about that before. Like, I want to know, I read 1-star reviews. That's what I read 1-star reviews first, because I want to know what's the bad stuff that can happen, so I can see if we're expecting that or I'm prepared for that. And I believe that that's more on the syndicator and operator and how they present their business model and their plan. Chris, would you agree with that?
Yeah, and part of the process that I take people through, because I come from kind of a business and finance background, and I ask them, when we're doing a PPM, what are your assumptions behind your projections you're giving to people? Because we want to make sure it's a disclosure issue too, because if you're assuming a certain rent growth or any other variable that you're assuming, you want to disclose that to your investors and make it clear. And like you're saying, that part of my job in the PPM is to tell everyone, like, this is not PPM is not really a marketing material, because I'm going to tell everybody all the potential risks of how this could fail. And that's my job to think about all of that. But the operator or syndicator needs to work through those issues and think about them too ahead of time. That shouldn't just be on me to come up with all the potential risks.
No, 100%. And really quick, if you've stumbled across this podcast and you do qualify, you're maybe a sophisticated investor, but you've never invested in one of these in a real estate syndication project. Chris or Shamir, whoever wants to jump on this, what does PPM stand for? I've always heard we should stop abbreviating things for people on shows, because we assume everyone knows what we're talking about.
Right.
So what does a PPM stand for, and what's the purpose of it?
So basically, when you go out and raise capital, pooling funds to invest in a real estate deal or invest in anything really, when you pool some funds into a company to invest into something, you're selling a security, which is covered by securities law, a number of different levels, federal and state. But there are certain obligations that you have when you go out to your investors, and basically to protect them, there are certain disclosures. One of those is a private placement memorandum, a PPM. That's just what everyone calls it. Offering memorandum. There's a number of different words that are used, but like when you buy a publicly traded stock, you might get a prospectus, which a lot of times has similar information about the business, who they are, what they do, how you're going to get your money back, what is your return, what are the risks of investing. That's the biggest one, to make sure that the investors are fully informed before they sign a subscription agreement, which is the most common way that people would sign in and decide to invest. Right. OA, operating agreement, that's usually covers how the syndication LLC is operated and managed. So those are kind of some of the more common terms.
Perfect. Thank you on that. And we talked about, Shamir had mentioned earlier that Texas is starting to hit their floor, right? We're starting to see that. Like, what do we see? What should people, or what are you guys kind of preparing for in 24? Right? You said, 23 is the numbers. We're not going to talk about the numbers because they weren't like 21 and 22. What are you guys kind of preparing for in 24 and 25?
Shamir, you want to jump in on that?
Yeah. So
a lot of unknowns.
Yeah, he doesn't sound that excited.
He's polishing
about
up his crystal ball right now.
Gosh,
Hold on. He needs a second.
Yeah, I don't hear the excitement in the voice.
So the 23 was slower, but it wasn't that bad, right? So right now we're on we're on pace to do about, I bet we'll do about 75 deals this year. It's not little or few.
Sure.
And we have a pretty high level of like penetration in Dallas, right? We get a good chunk of deals. The general consensus seems to be that 24 will be better, but really that's going to be wholly contingent upon interest rates, right? At the end of the day, that's what we're looking at. And if the market does actually slow down like it's supposed to, then interest rates ideally go down, and that's good for everybody. The flip side of that is also rent growth goes down. So, we expect that there's going to be an uptick in transaction volume, but I would have told you that last year too. The expected maturity, kind of what they call the wall of maturity, is supposed to come up soon. But yeah, as I had mentioned previously, like lenders are being more willing to work with borrowers, which is kind of pushing back the wall of maturity. And so that's kind of out there too. So there's a lot of unknown, and I think that that's okay. We're spoiled by the last few years where the money printer just goes burr, right? Like you just keep making money, and at some point that's going to stop, and that's okay. This is where the good guys earn their keep, and where the folks that maybe are not as qualified kind of get washed out, right? I mean, at some point that's how the market works. It's relatively efficient that way. And so yeah, look, I think 24 will be probably a continuation of 23. I think 25 is really where we're going to see some really immense uptick in transaction volume. 24 changes maybe if rates do start to drop. I saw recently they do this like poll of like mortgage bankers who I guess also have crystal balls like I do, and there was an expectation that rates would start to decrease at the end of 24. That's now been pushed out to the middle of decrease at the end of 23. Sorry, that's now been pushed out to the middle of 24. Yep. So the
just
same
in time for the election.
That's
right.
what I was going to say. That was my next question, Shamir. Is does the election does the election play into any of this?
Yeah, I think there's a lot of like macroeconomic factors that I think have an impact. I mean, does the election play into it potentially? Does what Fannie and Freddie does? There was an increase in the Fannie SBL limits yesterday, which then makes deals a little bit easier. So there's always little things happening, right? In Texas, for example, we had a change in the property tax rules that potentially could reduce property taxes or reduce the increase in property taxes on a certain kind of group of properties. Well, that makes those more desirable than they were prior to that change in rules. So there's always stuff happening, and it's happening at kind of the granular level, not like at the big headline level. It's all those little drips that combine to help create value, right? Like if you're ahead of the curve on, hey, look, property taxes are now going to be a little bit more efficient here, and you're ahead of the curve on, insurance, here's a better way to do it. You're creating value for your investors. You're earning that, because that's kind of what you get paid for as a syndicator, right? Is to like be able to create value for your investors in a way that your investors couldn't do it by themselves. And so kind of the way I see this right now is like the guys who are really good, the folks that are really, really skilled are still able to generate, return for their investors. The folks that are maybe less and that were kind of banking on cap rate compression over the last few years are still kind of struggling to figure out what they're going to do. And I want to step back real quick. So on the capital call question, I know we talked a little bit about kind of what's been driving capital calls. On our end, I will tell you that we had a series of deals obviously that closed or in the last 12, 18 months. A lot of those deals have had capital calls because when they went under contract and raised equity versus when they closed, the amount of cash required to close it stepped up because their interest rate cap prices stepped up.
Right.
So now they're short on cash to conduct rehabs and run the business, right? So like those guys are basically backfilling that capital that they had unexpectedly spent on interest rate caps or increased insurance premiums when they closed. So there was a lot of that then trickled into additional capital being required into deals.
Yeah, and they putting their own capital in too.
I'm sorry, Chris, go ahead.
One of the things also is when you're messaging with your investors, a lot of those guys that Shamir is talking about put a lot of their own capital back in or took reductions on their promote to incentivize either existing LPs or a new offering that, hey, we're willing to take a haircut on our side, or even put our own capital to make this deal happen. So it sends a good positive message if you're doing a capital call where, hey, we put our own capital in as well. We just need you guys to kick in some more.
Yeah.
So I think back to 2021, right? So we did 2 acquisitions in 2021, and they were heavy rehab repositioning. So we took bridge debt, right? But honestly, the concept of going with floating rate debt never even came into our periphery. Yeah. And with agency debt out there at that time at between 3 and 4%, why do you think, Shamir, so many of these deals were put on floating rate debt?
It's all LTV, right? It's all LTV. So they were doing you do floating rate deals, you do 80% LTV, you finance the entirety of your reno budget. This is high octane, high leverage debt. And I think part of the problem there is also you have people that were buying, and they were buying using bridge debt, but they weren't really thinking of it as bridge debt. They were thinking, bridge debt means it's a bridge to agency.
Right.
Right. But if your plan is, I'm going to take bridge debt and it's a bridge to a sale, it's not a great idea. You got to plan for the agency component, and if you can sell, you sell, right? So I think that was part of the challenge when people were getting really aggressive in their assumptions on rehab cost, on rent increases resulting from rehab costs, on rent, all of those elements.
Crazy, right?
We've talked about that so much.
So many times.
A bridge to nowhere.
Yeah, a bridge to nowhere. Yeah. Look, I mean, I think I would see broker, financing recommendations in OMs and stuff, and there would always be the floating rate bridge or floating rate agency, and honestly, I don't think I've ever underwritten a floating rate deal, right?
Yeah.
To me, it just fixed as the default, and will continue to be, by the way, right? Yeah. You've got to have. There's so many variables in this business that your interest rate, at least in my opinion, we could probably have a whole show on this. Right. In my opinion, interest rate risk is something that's easily mitigated by making sure you raise enough equity and checking the right box, right? There's so many other factors that you got to do, and just take that off the table. Sleep good at night.
Yeah, I mean, I think one of the things we were talking about the other day was for the last couple of years, we had guys buying floating rate debt with rate caps. Well, is now the time to be thinking about buying? They bought floating rate debt with rate caps, and then they got kind of jammed into deals where the rates went up, right?
Right.
So is now the time to be thinking about buying floating rate debt where we could potentially be at the peak of where those rates are going to be, and the trajectory is only downwards?
Yeah.
And if that's the case, then what does that do to transaction volume?
Yeah.
Yeah. You're the second person that mentioned that in the last couple of weeks, as far as, I think, are we gonna, or is now the time to get into floating rate? But honestly, we'd have to have,
or after the first Fed cut, because to get into the floating rate, your premiums are going to be astronomical.
There we go back to buy on mystery, sell on history.
That's
right?
what I'm saying. You could really try to time the market right now, but if it doesn't, you're committing to
inflation was up in July over June, right?
Yeah.
So, yeah. To me, that's the game of chicken, right? Is now the right time to start using floating rate debt? And I think, I don't know, I'd have to see a really good business case on why now is the right time. I just think
as a syndicator, you have a fiduciary obligation to control as many variables as you can possibly control.
Right.
And if you can control the variable of interest rate, I think that you are charged with that responsibility.
I agree, but can you imagine going to your investors, right, with a deal? And it's like, listen, I know you're getting 5% zero risk money market returns at JP Morgan Chase, but I have this great deal. And by the way, we're going to finance it with floating rate debt. I don't know. I think that's like a lead balloon conversation.
It feels like it. It could pay off massively.
It could.
But
we've been thinking about this a bunch. And for me, the way I think about it is first of all, I'm not an advocate either way, right? I am
Yeah.
no dog in this hunt. I just want to do deals. But when we've seen clients that have been extraordinarily successful, they've also been willing to take a little extra risk with their own cash. So, they would, instead of maybe buying a large deal with fixed rate debt right now, they would buy a mid-size or a smaller deal with floating rate debt and say, okay, maybe I can write this down, and even if I don't, I'm overcapitalized, so I'll be fine.
Yeah. But the deal profile changes.
Yeah.
So
and I think
something in that equation still changed.
Right, and that's part of what we've seen right now, right? Is like the days of like the 30, 40, 50, 70, 80 million dollar deal are gone. Like I haven't done a $100 million deal in 18 months.
Yeah.
But I've done a ton of like 10, 15, up to about 20.
Right.
And a ton of sub 10. Because at that price, you can make the LTVs work to go agency. The risk is far less. Like you're getting a lot of the value of multi without like the risk of having to go high risk agency,
Right.
Yeah.
A high risk bridge. So
Right.
that that's kind of one of the big trends we've seen is just that like smaller assets are transacting much faster right now than large assets. And in fact, we had a client that has like a 430 unit deal, and they were like, look, why don't we, we've got this cap payment coming. What if we, and the deal, the way that it's geographically located, there's like two phases. What if we separated this deal into two phases again, like it was originally before we bought it, and sold one phase in a 120 unit deal, which is within that sub $20 million market,
Right.
and then held on to the other phase and used the money from the first sale to fund a pay down of the loan.
Smart.
And I was like, okay, like I can see that making sense given that the sub $20 million market is far more active in terms of transaction than the 60, 70, $80 million market that you would have to be in to sell the entire deal by itself.
That makes sense.
Interesting.
That makes sense.
Interesting.
So there is a degree of creativity there. And look, I will tell you, we've done deals all over the country. We have some of the best multifamily real estate brokers and creative real estate brokers in the country in Dallas. I don't care what shop you deal with, and we deal with all of them very, very, very often. These guys are all really good.
Yeah.
And they're all very, very smart. They're all very, very knowledgeable, very, very capable. Go do a deal in like, some other, premium Dallas markets, and you're kind of like, my Dallas guys are really good compared to their guys. And so, there is a level of like, let's rely on the guys who know the market, right? Because they're making the market.
Right.
Nice.
That makes perfect sense.
All right, guys, we're coming up on time, and I kind of wanted to use the next couple of minutes to plug PLG, right? So Patel Law Group, you guys are awesome. I think, Shamir, Mike and I were in your office on a legal pad with a Coke Zero and thinking like 2018. And we finally had the chance to do business, starting in 2020 or 2021. So, you guys have been great, and the transformation you've gone through in the last couple of years is awesome. In the course of our due diligence, right, we, of course, looked at other syndication attorneys that we wanted to partner with. And one of the common things I would say is that you can go find a syndication attorney or a securities attorney, but that's not necessarily a one-stop shop for all you need to execute a multifamily transaction. So I think you opened it up saying you handle more of the real estate side and Chris handles the security side. So give us a little bit more insight on the delineation there and why that creates, why that makes PLG a very viable partner in this business.
Let me take part of that, and Chris, you take the other part. So
Yeah.
when we started doing deals, one of the things we figured out was, syndication and the fund and the equity component is a critical component of getting a deal done. And we looked at other firms that were doing it, and I tried to do it all myself initially. It wasn't great because I didn't have the time. We looked at other firms that were doing it, and they had, you'd have a senior level attorney and a junior level attorney, and there was kind of a step down in quality, whether it was a senior securities attorney, junior transactional attorney, junior transactional, senior securities, whatever it is. So we said to ourselves, we need to build a model where both the transactional side and the security side are given the same amount of quality of expertise. You've got the same level of just greatness on both sides. And so we went on a really long, really diligent search to find Chris a few years ago, and that was for us a really pivotal component of scaling out the law firm and the transactional side. And we operate in parallel. So I run the transactional side. Chris's team runs the security side. We're next door to each other, but we're doing both at the same time rather than waiting for one to complete and the other to start. And that's critical, Chris.
Yeah, it helps the communication aspect. And I mean, you meet a lot of guys who are like, oh, well, I have a real estate attorney and he'll handle my syndication. And, to be honest, securities law is very specialized. Even somebody who says they're a securities attorney may not necessarily really know securities law that well. They might be a real estate attorney who knows a little bit. Okay, I got to do a PPM, I got to do this or that. But do they really understand the Securities Act, the Exchange Act, Investment Company Act, Investment Advisors Act? I mean, they really have to understand that stuff well. So I have my own separate department, my own separate corporate and securities paralegal and associate attorney. So we're kind of on our own island here, but we're right next door to Shamir and the real estate transactional team. So we're working hand in hand on transactions. So the communication is quick. We're closing deals. We're in constant communication about them. And we kind of handle our own specialized area as well. Somebody comes to me with a PSA. Yeah, I can review it and provide decent comments, but nothing like Shamir and his team could. So I think it works pretty well that way.
Yeah.
Yeah. Securities is kind of a unique area of law in that there's a lot of detail, right? You got to be, typically big firms, they'll trap the securities guys in a basement and let them hang out with, these big books of Securities Act and the Investment Company Act. I mean, there's a lot there that even, I did some PPM work at a very, perfunctory level, but when Chris came in, I learned a ton from him when he joined us. And I think that, that level of just pure, deep in the weeds expertise on all facets of the security space is important. And I think that there were elements that, nobody in our market was looking at until Chris came in and was like, hey man, we need to really look at this more closely. So, I think the expertise and his value in terms of what he brings and the depth of expertise is particularly important and particularly well appreciated in our community and in the multifamily and the real estate space.
Nice.
Yeah, not everyone likes what I have to tell them about all the risks that you disclose and then some of the questions I ask them, but that's part of my job. And I used to, in the past, I took a company public, did all their securities filings. So I'm used to dealing with the SEC directly and filing documents that are going to get reviewed by the SEC and questioned. And as a securities attorney, your syndication attorney needs to understand that, hey, just because this is a private placement, a Reg D offering, however you're doing it, if the SEC ever was involved or their investor lawsuit, there are certain things they're going to look for that the rule might not say it's supposed to be in there, but that's something they're going to be looking for in terms of disclosure. And so that's kind of how we look at it.
Nice. So I'm going to talk to everybody, all our listeners here in a very practical perspective, right? So we've had a couple of really open discussions about, starting in multifamily when you have a W-2 and kind of the efficiencies in working with a broker like Terry Dale or any of the other big brokerages out there, as opposed to go financing one bank at a time. And dude, you're busy, I'm busy, Brian's busy, but in dealing with PLG, we would frequently ask Chris a question and Chris would have to say, that's more of a Shamir question.
Yep.
Or in an outside circumstance, if you're talking to a securities attorney and you ask them a real estate question, if they don't have anybody on the real estate side in their practice, now you got to go talk to a different attorney, right? 2 retainers, 2 agreements, 2 different points of contact, so on and so forth.
Just takes more time.
Yeah, and one of the things I really appreciate about working with PLG is it's a matter of them copying the next person on that email chain and asking a question. And I mean, we had pretty much real-time answers to anything that we needed as we closed, BC.
Yeah, no, it was a great experience. And I know that I think my other groups have used some others in the past. So this has been a really look. We'll from here on out we'll only use Patel in their group.
Okay. Agreed. And Chris, I don't know if you heard that, but I'm pretty sure Shamir said that it's all because of you, pal. So thanks for coming from California.
Exactly. I did catch that. Yes. Yeah.
I'm that all the time. It doesn't exist without
He's
you.
getting compliments today and convos with Mark Cuban yesterday. Chris is the man.
You can see that Mark Cuban glow on his face.
You definitely can.
Exactly. Yeah.
Just go to Patel Legal, right? So patellegal.com would that be the best place, or?
Yeah, and also you can go on YouTube. It's Securities Law Media. I do a ton of educational free videos on syndications, real estate, all kinds of stuff. So that's YouTube, Securities Law Media, or under my name, and then patellegal.com is our website.
Chris's video series is awesome for anybody looking to get into syndication, private offering, and he's got both videos on the syndication side and also on the blind pool fund side, right? Because we do a bunch of fund formation for guys that'll do like, I buy some multi here, some retail here, some industrial here, and they want to do a blind pool fund. He's got a bunch of videos about the difference between those two things and how that fits together for our clients, and that's been really cool.
Jesse, can we make sure to put that YouTube channel in the show notes?
Yeah, we will.
Awesome. So we'll link that in the show notes because there's not a lot of good information out there. So that's I've gone and searched for it and said, hey, if I'm going to do this at a high level, I want to know what I'm talking about. And then usually you run into all the gurus that are trying to sell their courses on it. And so this is free and it's straight from a securities attorney.
Yep. And I see Chris active almost every day on LinkedIn in some way, and he's definitely getting out there. And I think Mike attended the fund meeting or the fund workshop a month or so ago.
Yeah, we try to do educational seminars and other things, so watch out for that. We do them. Probably going to start doing some webinars, but we've done them in our office as well.
Awesome.
Yeah, so just go to patellegal.com. Well, thank you guys for joining us, unless you have anything else.
I was just going to ask Shamir and Chris if they had any last nuggets they wanted to leave the listeners with, but if not, we can certainly wrap up.
So we're not seeing the distressed assets everyone's talking about yet, but that could be coming. So for 2024, like Shamir had said, we are seeing an uptick in transactions over the last 2 months or so, both syndications and purchase and sales. So I don't know if those distressed assets are going to hit at some point in the future, but we'll see.
Awesome. Anything from you, Shamir?
Yeah, I think that, there's a lot of, it seems like there's a lot of dry powder still on the sidelines. And so even to the extent that distressed assets do hit, I think it seems like everybody and their mom has a distressed asset pref fund right now. So don't do another one of those. But in all honesty, I think that you are going to see some deals that are good value, and I think from a macro perspective, I think you are going to start to see pricing really get compelling. And I'll tell you to add to that, we've told our clients to really try to diversify their asset class. Look at retail that pays an 8.5 cap rate. Look at industrial that's starting to really become compelling. And so, we've got more and more clients looking at more and more asset classes beyond just multi.
Nice. Yeah, I've heard a lot about the diversification lately, and we've actually started some wheels in motion there too. Well, you guys have been awesome. Thanks so much for finding the time for us. To all our listeners, if you are the owner of a distressed asset, or if you know someone who is the owner of a distressed asset, feel free to give us a call or shoot us a note at deepbluere.com. If you're looking to do deals out there, especially in the DFW area, PLG's right here in Irving, and these guys are great guys and have definitely earned our complete trust. So give these guys a shot, and you'll be amazed at what these guys can do.
Appreciate that.
Perfect.
Cool.
Thank
you guys.
Thanks, guys. Thanks, everybody.
Thanks.
Thank you. See you next time.
Yes, sir.
Take care.
Later.